In this video, we're going to break down the statement of financial position terms. We can see an example on screen of a statement of financial position, and highlighted are the key terms. We're going to break it down section by section here and explain what each heading means and generally what goes into those headings. On certain headings, there are formulas you need to use to find the figures. When this is necessary, I'll put the formulas on screen. I have an in-depth video on how to complete a statement of financial position that I'll link below. It goes through it thoroughly and in detail, so check it out if you need any help. First up, we have fixed assets. Fixed assets are long-term resources that a business owns and may use to generate income over several years. Example of fixed assets would be buildings or offices that a business owns and operates out of. Machinery such as equipment used for production, and vehicles such as delivery trucks or company cars. Imagine you own a sports store. The building where you sell the sports gear, the delivery van used to transport the equipment, and the gym machines you use for customer demonstrations are all fixed assets because they'll help your business for many years. These items don't turn into cash, but they are essential for running your business in the long term. Fixed assets are subject to depreciation. I have another video done on depreciation, what it is and how to calculate it, and I'll link it below. Next, we have current assets. These are short-term assets owned by a business, such as cash or items that can be expected to be converted into cash within 1 year. Current assets include things like stock or inventory. This is because you would be expected to sell this stock within a year and generate cash from these sales. Another current asset is money that is owed to you by customers. These are called debtors. And finally, any cash that you may have on hand is of course a current asset too. In your sports store, the inventory of footballs, running shoes and jerseys are all current assets. You also have cash in the register and some customers who bought products on credit and haven't paid you yet. These are all examples of current assets. Now, let's talk about current liabilities. These are amounts a business owes and need to pay within a year, like bills, wages and short-term loans. If you bought a large stock of football boots for your sports store on credit and need to pay the supplier within 30 days, that's a current liability. Other examples of current liabilities include electricity bills or wages you need to pay your staff for at the end of the month. Next, we have working capital. Working capital is the money a business has available to cover its day-to-day expenses. Working capital is calculated by taking your current assets, which is what you have available to you to convert within cash within a year, minus your current liabilities, debts you have to pay within a year, and this leaves you with a figure, and this figure is called working capital. Basically, it's taking what you owe away from what you have. Let's say the sports store has €50,000 in current assets, including stock, cash and money owed by customers. You also have 30,000 in current liabilities, like payments you owe to suppliers and utility bills and wages. So your working capital is €20,000. This means your sports store has enough money to comfortably cover its short-term expenses. If your working capital is positive, that's a good sign the business can handle its immediate financial needs. If it's negative, it means the business could struggle to pay its bills on time. Now let's talk about total net assets. Next, let's talk about total net assets. This is a key figure that shows the overall value of the business after all liabilities, which are debts, have been subtracted from the total assets. To find your total net assets, you add your working capital onto your total fixed assets. So let's say your sports store has €80,000 in fixed assets. Its working capital is 20,000. This means that the business's total net assets are 100,000. This is the real value of the business once all debts are taken into account. If your total net assets are positive, the business is in a healthy financial position. If they're negative, the business might have more liabilities than assets, which can lead to problems further down the line. The next few headings are quite technical, so you might have to pause and rewatch this a few times until it sinks in. So, finance by. This section explains how the business has been financed. It includes various sources of funds such as share capital, reserves and retained profit. Essentially, this is where the business's money is coming from. So let's break it down. Share capital. This is the money raised by selling shares in the business. The authorised share capital is the total amount the company can issue, and issued share capital is the amount that has been sold to shareholders. Example: if your sports store has an authorised share capital of 200,000 and issued share capital of 50,000 euro, this means that your store has only sold 50,000 euro in shares. Reserves. These are profits that have been set aside for future needs such as growth or unexpected expenses. Within this, we generally see retained profit, which is the profit that the business has earned but not paid out to shareholders as dividends. It's kept within the company to help with future growth. This figure comes from a company's income statement. Generally, you'll see this as the net profit figure on the income statement. Next up, we have long-term liabilities. These are debts that the business owes and will take more than 1 year to pay back. This could be things like bank loans or a mortgage. So let's say your sports store took out a loan to buy a delivery truck, and the loan needs to be paid back over 5 years. That's a long-term liability. Even though you'll pay small amounts each year, the overall debt remains for a long time. Finally, we have capital employed, and capital employed refers to the total amount of capital that is used to fund a company's operations and is typically calculated as the sum of shareholders' equity and long-term liabilities. So going back to the sports store, say we have an issued share capital of 50,000 euro, which is what we sold in shares, and a long-term loan of 30,000 euro. This would mean our capital employed is 80,000 euro. This money is used to run the store, buy products, pay wages, and generally keep the store going. To make sure we've calculated everything correctly here, our total net assets figure at the top of our statement of financial position and our capital employed at the bottom should be the same. In other words, they should balance. This is a good indication that we've done everything right. And that's basically the video, summing up all the key terms in the statement of financial position, and hopefully you found this video helpful.